When it comes to investing, there's this one little number that has an absolutely unbelievable power over your long-term success. And no, it's not the market's return or your genius stock picks. It's a tiny percentage, usually hiding in plain sight, called the expense ratio. So let's dive into this and see just how much this single number can really cost. But first, let me ask you something. Just think about it for a second. What could you do with an extra, $145,650? Seriously, is that a down payment on a house? Maybe college for the kids? Or hey, that sports car you've always kind of wanted? All right, hang on to that number. Because believe it or not, that staggering amount is exactly what a seemingly tiny 1% fee can quietly drain away from a $100,000 investment over 30 years. And it's not just the fee itself, right? It's the loss of all the future growth that money could have made for you. That's the real cost we're going to unpack today. Okay, to really get how this happens, we have to start with the part of the cost that's right there in front of us, the expense ratio itself. This is the fee you'll see on every single fund's fact sheet. So what is it exactly? Well, the expense ratio is basically the yearly price tag for owning a fund. It's shown as a percentage of your investment. And the sneaky part is, it's taken out automatically from the fund's assets, so you never actually see a bill for it. It's just this invisible drain on your returns, happening day in and day out. Now, what's really interesting here is the breakdown. The expense ratio isn't just one thing, it's a whole bundle of fees. The biggest slice of the pie is almost always the management fee. That's what pays the portfolio managers. Then you've got administrative costs for stuff like accounting and sometimes marketing fees, though you don't see those as much in ETFs these days. The main thing to remember is you're paying for all of this, whether the fund makes you money or not. And this brings us to the most important concept in all of investing, compounding. We all love it when it's working for us, but it's got a dark side. When you apply compounding to fees, it turns into this relentlessly corrosive force, creating these huge gaps in wealth over time. And wow, this slide just shows the damage perfectly. Just look at that difference. You start with the same $100,000, you get the same 7% annual growth, but the low-cost fund grows to almost $755,000. The high-fee fund, it only gets to about $574,000. That huge gap between the bars, that's your money. Gone. Let's look at this table and see how that gap just gets wider and wider. After 10 years, the difference is about $17,000. Okay, that's annoying, but maybe not life-changing. But fast forward to year 20, and suddenly it's over $60,000. And by year 30, boom, it's exploded to more than $180,000. See, the fee isn't just costing you money today. It's robbing you of decades of future growth. But here's the real kicker. That expense ratio? That's not the whole story. It's not even close. To truly understand what you're paying, we have to look below the surface and uncover what's called the total cost of ownership. This quote just nails it, doesn't it? The expense ratio is just the part of the iceberg you can see. The real danger, the bulk of the cost, is often lurking right below the surface, in places you might not even know exist. So the key thing to get here is that there are two kinds of costs. The expense ratio is your holding cost. That's what you pay just to own the fund. But the total cost of ownership also includes trading costs. These are the expenses that pop up when you buy and sell shares, and also the costs the fund itself racks up when it trades. So what are these hidden costs? Well, they come in a few different flavors. You've got the bid-ask spread. That's a tiny markup you pay every time you trade. Then there are premiums and discounts, which means you might buy for a little more than the fund is worth or sell for a little less. Tracking error means the fund isn't perfectly following its index. And then there's the big one, taxes. The tax cost ratio, or what some people call tax drag, is often the single most significant hidden cost of all, especially if you're investing in a regular taxable account. And this is where you see a massive difference between different kinds of funds. I mean, look at this chart. The average U.S. equity mutual fund investor could lose almost 2% of their return to taxes every year, while the average ETF investor loses less than half of that.
So why are ETFs so much more efficient? What's their secret sauce? It's not magic. It actually comes down to their fundamental structure. Let's dig into why that structure matters so much for your wallet.
The secret weapon is this process called in-kind redemptions. Okay, it sounds technical, but it's actually a pretty simple, genius idea. When a big institution wants to sell its ETF shares, the ETF manager doesn't sell stocks and hand over cash. Instead, they just give them a basket of the actual underlying stocks directly. This simple swap means a taxable event is never triggered inside the fund, a huge benefit that gets passed right on to you. And this one difference has a massive impact on you, the investor. With a mutual fund, when someone else sells their shares, the fund manager often has to sell stocks, which creates costs and taxes for everybody still in the fund. You're literally paying for someone else's decision to sell. With an ETF, those costs are stuck with the person who's actually doing the trading. Plus, ETFs don't have to hold much cash, so they avoid the performance cash drag that can really hold back a lot of mutual funds. Okay, that was a lot of info, I know. But now that we understand the problem, let's get practical. Knowledge is only power if you actually use it. So here's a simple toolkit you can use to fight back against high fees and make sure you're keeping more of your own hard-earned money. Here's a 5-step framework you can put into action right away. 1. Stick to broad market index funds. They're almost always the cheapest. 2. Watch out for fee waivers. Make sure that super low fee isn't just a temporary teaser rate. 3. If you trade a fund a lot, add the bid-ask spread to the expense ratio to find your real cost. 4. Use your tax-advantaged accounts, like a 401k or an IRA, for your least tax-efficient funds. And 5. Look for funds with simple, all-in, unitary fees for total transparency. So let's end on this. Your capital is working hard for you every single day. The critical question you really have to ask yourself is this: is it working primarily for you and your future, or is a big chunk of it working for your fund manager? By understanding and fighting back against fees, you can make sure the answer is always, always you.